Many people find the stock market intimidating. They see it as a complex and risky game reserved for experts. But understanding the stock market doesn't have to be difficult. This guide will break down the basics of the stock market in a clear and simple way. Whether you are completely new to investing or just need a refresher, this guide is for you. Let's demystify the world of investing together. The stock market is essentially a platform where buyers and sellers trade pieces of companies. These pieces are called stocks. When you buy a stock, you're buying a small ownership stake in that company. The stock market is driven by supply and demand. When more people want to buy a stock, its price goes up. Conversely, when more people want to sell a stock, its price goes down. Investing in the stock market can be a rewarding way to grow your wealth over time. However, it's important to remember that investing always comes with risks. It's crucial to do your research, invest wisely, and be prepared for both the ups and downs of the market. The stock market, as we know it today, traces its roots back to the 17th century. One of the earliest and most notable examples is the Dutch East India Company. Established in 1602, the Dutch East India Company was a powerful trading company. They wanted to raise capital for their ambitious voyages to the East Indies. To finance these expeditions, the company issued shares of stock to the public. Individuals could purchase these shares, becoming partial owners in the company. This allowed the Dutch East India Company to amass a vast fortune. This innovative approach to raising capital marked a pivotal moment in financial history. The concept of stock trading spread rapidly across Europe. Soon after, stock exchanges began to emerge in major cities like London and Amsterdam. These early exchanges provided a centralized location for investors to buy and sell shares of companies. This laid the groundwork for the modern stock market we know today. In its simplest form, the stock market is a marketplace where stocks are bought and sold. Think of it like a giant auction house. Buyers place bids on stocks representing their desired purchase price. Sellers set asking prices indicating the minimum amount they are willing to accept. When a buyer's bid price matches a seller's asking price, a trade occurs. The stock price is determined by the constant interplay of supply and demand. If there's high demand for a particular stock and limited supply, its price will rise. Conversely, if there's low demand and an abundance of sellers, the price will fall. The stock market provides a platform for companies to raise capital and for investors to participate in their growth. The stock market plays a vital role in modern economies. It provides companies with access to capital. This enables them to expand their operations, invest in research and development, and create new jobs. For investors, the stock market offers an opportunity to grow their wealth over the long term. By investing in companies they believe in, individuals can potentially benefit from their success. Companies have various reasons for choosing to go public, which essentially means making their stock available for trading on a stock exchange. One primary reason is to raise capital. Going public allows companies to sell shares to the public and raise significant funds. This process of going public is called an initial public offering, or IPO. Companies use the IPO proceeds for various purposes such as funding expansion plans, investing in research and development, or paying off debt. Going public also provides existing shareholders such as founders and early investors with an opportunity to liquidate some or all of their holdings. Becoming a publicly traded company comes with certain obligations. Public companies are required to disclose their financial information regularly. They must also adhere to stricter regulatory standards. This transparency can enhance a company's credibility and attract a wider investor base. Section 5. How investors make money. Investors can make money from stocks in two primary ways: capital gains and dividends. Capital gains occur when an investor sells a stock at a higher price than they purchased it for. For example, if you buy a stock for $50 per share and later sell it for $75 per share, you would make a capital gain of $25 per share. Dividends, on the other hand, are payments made by companies to their shareholders, typically in the form of cash. When a company generates profits, it may choose to distribute a portion of those profits to its shareholders as dividends. Not all companies pay dividends. Companies in a growth phase often reinvest their profits back into the business. The stock market offers investors the potential for long-term growth. Historically, the stock market has trended upwards over the long term, although it can experience short-term fluctuations. Investing in stocks allows individuals to participate in the growth of companies and the overall economy. Section 6. The stock market and the economy. The stock market and the economy are intricately intertwined. The stock market is often considered a leading indicator of economic health. When the economy is strong, businesses tend to perform well, their profits increase, and their stock prices rise. Conversely, during economic downturns, businesses may face reduced consumer spending, lower profits, and declining stock prices. Various factors can impact both the stock market and the economy, including interest rates, inflation, and geopolitical events. For example, rising interest rates can make it more expensive for businesses to borrow money, potentially slowing down economic growth. Similarly, high inflation can erode consumer purchasing power, leading to decreased demand for goods and services. Geopolitical events, such as wars or trade disputes, can create uncertainty in the market and negatively impact investor sentiment. Understanding the relationship between the stock market and the economy is crucial for investors. It helps them make informed investment decisions based on their assessment of current economic conditions. Section 7. Starting your investment journey. In today's digital age, starting your investment journey is easier than ever before. Numerous online platforms provide access to the stock market, such as online brokerage accounts and robo-advisors. Online brokerage accounts allow investors to buy and sell stocks and other securities directly. They offer a wide range of investment options and research tools. Robo-advisors, on the other hand, provide automated investment management based on your financial goals and risk tolerance. They create and manage a diversified portfolio of investments on your behalf. When choosing an investment platform, consider factors such as fees, account minimums, and the level of investment guidance and support provided. Before you start investing, it's essential to determine your investment goals, risk tolerance, and time horizon. Your investment goals might include saving for retirement, purchasing a home, or funding your child's education. Your risk tolerance refers to your ability to withstand fluctuations in the value of your investments. Your time horizon is the length of time you plan to invest. Section 8. Understanding the risks. While investing in the stock market offers the potential for growth, it's crucial to understand the risks involved. The stock market is inherently volatile, meaning that stock prices can fluctuate significantly in the short term. There's always the risk of losing money in the stock market. Diversification is key to mitigating risk. By investing in a variety of stocks across different sectors and asset classes, you can reduce the impact of any single stock on your overall portfolio. It's important to debunk common myths surrounding the stock market. One prevalent myth is that timing the market is essential for success. However, consistently timing the market's ups and downs is extremely difficult, even for experienced investors. Another myth is that investing in the stock market is equivalent to gambling. While both activities involve risk, investing is based on careful analysis, research, and a long-term perspective. Section 9. Final thoughts and tips. In this guide, we've covered the fundamentals of the stock market. We've explored its origins, how it operates, and the various ways investors can participate. Remember that investing in the stock market is a journey, not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. Here are a few practical tips for beginners. 1. Start small. Invest an amount you're comfortable with and gradually increase your investments over time. 2. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different stocks and asset classes. 3. Do your research. Before investing in any stock, take the time to understand the company's business, financials, and growth prospects. 4. Be patient. Investing is a marathon, not a sprint. Don't panic sell during market downturns. Stay focused on your long-term goals. Remember to consult with a financial advisor for personalized guidance tailored to your specific financial situation.